Most traders blow their account not because they can't read charts or not because their strategies are not working. They blow their account because they refuse to respect risk management. And we are here to fix that today. Welcome back to episode 7 of our series. Today we are covering the trader's trinity: risk, reward, and trading psychology. And honestly, this might be the most important video of the entire series. In the previous episode, we covered position sizing, pips, lots, leverage, margin, and how they affect your account. If you haven't watched that yet, the link is in the description. Go watch it and come back for clearer understanding. Today we are talking about the mindset that separates a consistent trader from an emotional gambler. So let's dive in. Let's start with a mind-blowing fact. Do you know that you can be wrong 70% of the time and still make money? It comes down to your risk to reward ratio. Let's break it down. Risk to reward ratio is simply the ratio of your potential risk to your potential gain. Take a look at this setup. The entry is at 1.3326. Stop loss is at 1.3276. That is 50 pips. And then take profit level is at 1.3477. And that is 150 pips. That means your risk to reward ratio is 50:150. And that will be 1:3. And here is why this matters. If you take 10 trades with 1:3 risk to reward and loses 7 of them, but wins only 3, you will still be in profit. If you are risking $10 per trade, your potential target will be $30. So if you lose 7, that will be $70. But if you win 3, that will be $90. Your net profit will be $20 despite winning just 3 of the trades. Just 3 wins covers all the 7 losses and still makes you profit. You don't need to be right all the time. You just need a proper risk to reward ratio. But even a great risk to reward ratio cannot save you if you bet all your account on one single trade. The golden rule in trading is simple. Never risk more than 2% of your entire account balance on one trade. Just 1% might look small, but let's look at it this way. If you have $1,000 account and risk just 1% of it, that will be $10. If you lost 10 trades, you will be down by 10%, and that will be $100. But you'll still be in the game with $9,000 account. But if you are risking higher, let's say 10%, just 5 losses will send you to 50% down. That sudden loss can cause a devastating psychological damage. Your risk to reward ratio values should determine which lot size to use. Here is how to calculate it. Your lot size is calculated as your account balance multiplied by your risk percentage, all divided by your stop loss pips, all divided by the value of 1 pip of a standard lot size. For example, if you have $1,000 account, risking 1% of it, that will be $10. And your stop loss pips is 20 pips. In the previous episode, we learned that the value of 1 pip with a standard lot size is $10. So your lot size will be calculated as the account balance, which is $1,000, multiplied by 1%. 1% means 1/100, and that will be 0.01. All divided by your pip value, and here our pip value is 20. All divided by 1 pip value of a standard lot, which is 10. And that will be 0.05 lots. Let's try another example. If you have $500 account, risking 2%, 2% of 500 will be $10. And your stop loss pip is 10 pips. Your lot size will be calculated as your account balance, which is 500, multiplied by your risk percent, and that will be 0.02, all divided by our pip value, which is 10. And then further divide our final answer by 10, and we will get 0.10 lots. That was a lot of math, but don't worry. You don't need to memorize all those formulas. I've built a simple calculator that does everything for you. The interface is clean and easy to use. Just enter your account balance, your risk percentage, and your stop loss pips. Click on Calculate, and the app instantly gives you your risk amount, your lot size, and even your risk reminder. I'll leave the link to the app in the comment section. From these examples, you can see that everything is built on your stop loss. So your stop loss shouldn't be suggested. It should be based on technical levels. And once it is set, never move it. Because moving it just by a single pip will affect your entire risk to reward management plan. And this can turn a small loss into a big one, or even blowing your entire account. Now let's talk about the biggest obstacle you will ever face in your trading career. It's not the market. It's not your strategy. It is you. Your inner demons. The mental game. Trading psychology. Your biggest enemy in trading is not the market or your strategy. It is you. Your emotions, your trading psychology. You can have the best trading strategy and also the best risk to reward management plan. But if you lack the mental endurance to accept both your losses and your wins, you can't survive. Here are some of the psychological demons you face in your trading journey. How to spot them early, how to kill them before they killed your account. And number one is revenge trading. You lost a trade, and out of anger, you immediately jump into another trade to make your money back. This is emotional trading, not strategical. Your revenge usually ends up in another loss. More emotional damage, more losses. As a trader, you should always train your mind to accept losses. And when you lose a trade, step back for about 30 or 1 hour from the chart. Let the emotional damage fade. And when you come back, try to identify what went wrong in the previous trade. Readjust and always follow your trading plan. Number 2, fear. Fear of missing out. In short, FOMO. You see the price shooting up and you think you are missing out. You are missing the move. And jump in at the worst possible spot. And the market reverses. You feared you were missing out. But now the market reverses and left you out. The market is full of opportunities. If you miss an entry, accept it and don't chase the market. There is always another opportunity. The market will present another opportunity to you at the best possible time. Fear can also let you close trades too early. You entered a buy position and the market falls in a few pips. Out of fear, you close the trade and re-entered in a sell position, thinking you were wrong for placing a buy order. And what happened? The price reverses and it is now moving in your first trade that you closed. Not only will you lose twice, but you also regret. This is why it is always important to use a calculated risk to reward ratio management. Set a stop loss and a take profit for every trade. And don't move it. Don't modify the trade. It should only be closed by either your take profit level or your stop loss level. The third one is overconfidence. You just won 5 trades in a row and think you are now a genius. You have the best trading strategy in the world. You are now the market god. And what's happened? You double up your trading size. You increased your position size from 1% to either 10% or 50%. Because you are now confident in your trading strategy and think you will never lose. And if the market humbles you, a single loss can wipe away all the profit made from the previous wins. A series of wins does not make you the market god, and a series of losing trades does not mean you are the worst trader. Always stick to your trading plan and trust your defined risk management plans. Successful traders think in probabilities, not individual trades. You will face about hundreds of thousands of trades in your trading career, and that will determine your profitability, not just 1 or 10 trades. Before you take a trade, ask yourself these questions. 1. Ask yourself, is my risk to reward ratio and the lot size is well calculated? 2. Am I risking 1 to 2% of my entire account? 3. Is my stop loss based on technical structure and not my emotions or suggested? 4. Am I in the emotional stable to take a trade? And 5. Can I afford to lose the money that I'm risking? Is that not my school fees? Is that not my rental fees? Is this money not for my foodstuffs? If you cannot answer all these questions properly, don't click that buy or sell button, please. But if all these questions are checked in, trust me, no emotional demon can break you. A successful trader is not a trader with a 100% win rate strategy or with some magical indicator. It's a trader with a solid risk management plan and have full control over their emotions. They are the traders who take profits without any greedy and accept losses without it damaging their emotions and confidence. In the next episode, we will dive into technical and fundamental analysis. We will start building trading strategies based on top trading concepts. But before then, go to your demo account and practice your risk to reward calculation, position sizing, and test your emotions. Treat that demo account as real and test your emotional stability on a live trade. Remember, protecting your capital comes first, and then making money becomes second. I'll see you in the next episode. Stay disciplined and let's continue learning together. This is GeniusFX. Learn, trade, and profit.